Hello, my name is Brianna Batieste, and I will be covering the Working Capital Management Project and Report for eBay versus Amazon for Finance 301 Treasury Management. Throughout this presentation, we will be covering a variety of financial ratios, starting with liquidity ratios. Here for eBay versus Amazon, we have the current ratio, the quick ratio, and the cash ratio. The current ratio is determined by dividing the current assets by the current liabilities. The quick ratio is determined by dividing the current asset inventory by the current liabilities. The cash ratio is determined by dividing the cash by the current liabilities. Here we have the liquidity analysis. The current ratio. Liquidity ratio calculated is current assets divided by current liabilities. Amazon.com Incorporation's current ratio deteriorated from 2016 to 2017, but then it started to improve from 2017 to 2018, exceeding 2016's level. On the quick ratio, the liquidity calculated as the cash plus short-term marketable investments plus receivables divided by the current liabilities. Amazon.com's Incorporation quick ratio deteriorated from 2016 and exceeded the 2016 level. In the cash ratio, a liquidity ratio that was calculated as cash plus short-term marketable investments divided by the current liabilities. The Amazon.com's cash ratio deteriorated from 2016 to 2017, but then improved from 2017 to 2018, and it did exceed 2016's level. Next, we'll be covering the leverage ratios. Under the leverage ratios, we have the debt ratio, the equity multiplier, debt to equity, times interest ratio, and cash coverage. The debt ratio is calculated by the total assets minus the total equity divided by the total assets. The equity multiplier is calculated by the total assets divided by the total stockholders' equity. The debt to equity is total shareholders' equity divided by total liabilities. The times interest is calculated by the EBIT divided by the interest expense. The cash coverage is calculated by the EBIT plus depreciation divided by interest expense. Here I have a breakdown of eBay's debt to equity expenses, and this is going to be covering a visual representation of what is going on in the debt to equity ratio for eBay. So as you can see, we have debt in red, equity in green, and cash in blue. So the equity in eBay's company has a high level. It's operating at a high level. And the equity does cover the debt, and it also covers the cash. So the cash and the debt are fairly close, meaning that this corporation has barely just enough cash to cover their debt expenses. But coming into earlier the years, into 2018, 2019, their cash has declined and their debt has increased, versus in past years, whenever their debt was lower than their cash. So as time has continued, they are looking more towards debt. So the debt to equity ratio is a financial liquidity ratio that's going to be comparing the total debt to the total equity. So a higher debt to equity ratio indicates that more creditor financing, bank loans, is used than investor financing for the shareholders. So a lower debt to equity ratio usually implies that more financially stable businesses is what you're looking at. So comparing a higher debt to equity ratio is considered more risky to creditors and investors than companies with a lower ratio. eBay's level of debt compared to net worth is high. The level of debt compared to net worth has increased over the past 5 years. Debt is well covered by operating cash flow, and interest payments or debt are well covered by the earnings for eBay. Next, we will be covering the asset management ratios. Included in the asset management ratios, we have the inventory turnover, the total asset turnover, accounts receivable turnover, average collection cycle. For the inventory turnover, that is calculated by dividing the cost of goods sold by the average inventory. For the total asset turnover, we will be dividing the net sales by the average total assets. For the accounts receivable turnover, we will be dividing the net credit sales divided by average accounts receivable.
For the average collection cycle, we will be dividing the accounts receivable divided by credit sales times 365 days, which are within that period of that cycle. So what is accounts receivable? It's an efficiency ratio. It's a ratio that measures how many times a business can turn its account receivable into cash during a period. So accounts receivable turnover measures how many times a business can collect its average accounts receivable during the year. A turn refers to how many times a company can collect its average receivables. Since the receivables turnover is a measure of a business's ability to efficiently collect the receivables, it makes only sense that a higher ratio would obviously be more efficient, and a lower ratio is going to be less efficient. The inventory turnover ratio is also an efficiency ratio, and this measures how many times the inventory is turned or sold during a period. In other words, how many times a company is sold, its total average inventory dollar amount per the year. It's a measure of how efficiently the company can control its merchandise, so it's important to have a high turn. That way, it is indicated that the more inventory that they sell, the more money that's coming in. So the asset turnover ratio is an efficiency that compares the company's ability to generate sales from its assets by comparing the net sales with the average of total assets. This ratio measures how efficiently the firm uses its assets to generate the sales, so the higher ratio is always going to be more favorable in this instance. The average collection period is the amount of time that it takes for a business to receive payments that it's owed in terms of accounts receivable. The average collection period is calculated by dividing the average balance of accounts receivable by the total net of credit sales to see how fast that these customers are paying back on their credits that they have owed the company. Next is the profitability ratios. Under the profitability ratios, we have the total profit margin for eBay, the total turnover for assets, the total turnover on common equity, the return on common equity for Amazon, the operating profit margin, and the net profit margin for Amazon. So the net profit margin is calculated by dividing the net income by the revenue times 100. The return on total assets is calculated by dividing the EBIT divided by the average total assets. The ROE is divided by the net income divided by the shareholders' equity. The OPM is divided by operating income divided by the revenue times 100. The MPM is the net income divided by the revenue. So these ratios are all going to be from 2018 to 2014. And the total profit margin ratio is also called the return on sales, or the gross profit ratio, that measures the amount of income earned with each dollar that's generated on the sales by comparing the net income with the net on sales for the company. In other words, the profit margin will show what percentage of sales are left over after all the expenses are paid for by the business. So creditors and investors use this ratio to measure how efficiently a company can convert its sales into net income. They want to make sure that profits are high enough to distribute the dividends, while the creditors want to make sure that the company had just enough profits to pay back all of its loans. So extremely low profit margin would indicate that expenses are too high and that the management needs to budget and to cut down on their expenses, and that it will not be efficient to invest into that corporation if their expenses are way too high. The return on asset ratio is often called the return on total assets, and it is a profitability ratio that measures the net income that is produced by the total assets during a period by comparing the net income to the average of the total assets. So it measures how efficiently a company can manage its assets to purchase assets to produce profits during a period. So if the sole purpose is to generate income and revenue and to produce profits, then this ratio helps with management, and it helps with investors to see how well that the company can convert its investments into assets and into profits. So you can look at the return on investment of the company, since the assets are often the biggest investment for most corporations. And that will cover the total profit margin, the total return on common equity, and the operating profit margin. These investors and creditors want to see these numbers to be able to make a good indication on whether or not this company would be a good investment. Next, we'll be covering the working capital investment and the short-term credit. So the working capital is calculated by the current assets minus the current liabilities. So here on the slide, we have a period of over 5 years for the working capital turnover for eBay. And the working capital turnover ended up being 4.02, 2.28, 1.79, 1.52, and 1.99 for the working capital turnover. The working capital turnover is calculated by dividing the net annual sales divided by the average working capital. And the working capital is the current assets minus the current liabilities. Here we have an example for the working capital turnover. For net sales divided by working capital, the working capital turnover would be 34.71. The working capital turnover is an activity ratio calculated as revenue divided by the working capital. Amazon Incorporated's working capital turnover improved from 2016 to 2017, and then it started to deteriorate from 2017 to 2018. This is a graphical representation of Amazon's working capital turnover ratio. As stated before, it is the net sales divided by the working capital. So for 2018, the working capital turnover ratio would be 34.71. For 2017, it is 76.87. For 2016, 69.20. For 2015, 41.56. For 2014, 27.48. And all of these numbers were calculated by dividing the net sales by the working capital. And as the graphical representation, you can see that from 2018, we have gone to a decline, but in 2014, we were at a lower point. We did increase. Now, 2018, we're going back down. Here, there's a snippet of eBay's short-term operating activities ratios. So we have the receivables turnover, the payables turnover, and the working capital turnover for eBay. The accounts receivable turnover ratio is divided by the net credit sales divided by the average accounts receivable. The accounts payable turnover ratio is the total purchases divided by the average accounts payable. And that is how all of these numbers were calculated to retrieve this data. So let's continue to talk about turnover. Here above me is a turnover ratio for eBay in a 5-year period, but it's not including Amazon. So you see that we have a steady rate, and then we have a rate that shoots upwards, and this rate was in 2014. Going forward into the future, it has been more stable as far as their turnover ratios and their payables and their receivables. The accounts receivable turnover ratio is a measure of how many times the business can collect its average accounts receivable during the year. This ratio shows how efficient a company is at collecting its credit sales from the customers. The accounts payable turnover ratio is how many times a company can pay off its average accounts payable balance during the course of the year. So here I have also the ratios for average receivables turnover. For the accounts receivables turnover equals net credit sales divided by average accounts receivable. And then we have average collection period formula, which is accounts receivable divided by credit sales times 365 days. Here is an example of a receivables turnover. So the description that we're going to be giving is an activity ratio that's equal to the revenue divided by the receivables. So for eBay Incorporated, the receivables turnover has deteriorated from 2016 to 2017, but it did start to improve from 2017 to 2018, but it's not reaching the level that it needed to reach that was in 2016. So we have the net revenues divided by the accounts receivable. So for example, for December 31st of 2018, we have the net revenues of $10,000 at 746. Then we have the account receivables net at 712. So what we're going to do is we're going to divide the 10,746 by the 712 to get 15.09, which equals your receivables turnover for December 31st, 2018.
So here's just a quick recap on receivables, payables, and working capital. So the eBay Incorporated receivables turnover did deteriorate, but then it improved. The eBay's payable declined, and then it increased. The eBay's working capital turnover improved in 2016 and 17, and from 2018, so far it has been going pretty well. This is another graphical representation that I have created for eBay Incorporation for short-term operating activity ratios and the average number of days. So we're starting from 2018 to 2014. Blue is the average receivable collection period, and orange is the average payables payment period. So we see that we go from 44 to 54 to 51, 72 to 26 for the average payable payment period. Then for the average receivable collection period, we go from 24 to 27 to 24 to 26 to 16. So we're going from the early date as of today back. So from 2014, we went from 16 to 24 for the average receivable collection period. Then we go from 26 to 44 for the average payables payment period for eBay. eBay's short-term operating activity based on their average payables period was a little high, and then it started to decline in recent years. So estimates of the average number of days it takes for a company to pay its suppliers, they have not been doing as well recently as they used to do back in later years. Next, we have the inventory and accounts receivable management. This is a graph for eBay versus Amazon's accounts receivable turnover. So Amazon is in green and eBay is in orange. Amazon is clearly doing better, and they are operating at a more efficient level than eBay is. eBay seems to have these slopes in the graph where they do kind of chop, they go down and then they go up and then they go down and then they significantly shoot up. So there's a little bit of instability there. And then with Amazon, they have a very, very consistent positive correlation with their accounts receivable turnover. So I imagine that they are definitely managing their accounts receivable very, very well, because their slope is very consistent and it is sloping upwards. Next is the credit and accounts payable management. The payables turnover ratio is calculated by dividing the cost of net revenues divided by accounts payable. In this example, the cost of net revenues, $23.82, divided by 286 equals 8.33. The payables turnover is an activity ratio that's calculated as the cost of goods sold divided by the payables. eBay Incorporation's payable turnover declined from 2016 to 2017, but then increased from 2017 to 2018. So it did exceed the 2016 level. So here we have the December 31st, 2018, the eBay's payable turnover, and the answer is 8.33, which is a direct reflection from the payables turnover ratio average. Next, I have a graphical representation for eBay Incorporated's average payable payments period versus Amazon's average payable payment period as well. So we have from January 2014 all the way to January 1st on 2018. So green is eBay and orange is eBay's average payable payment period. Blue is Amazon.com. The green is, once again, eBay's, but that's eBay's payable turnover. So Amazon is consistently operating more efficiently as far as their payables, and just overall, they seem to be managing their money well as far as how they are collecting and receiving everything that they're doing. eBay's average payment period went on a rise from 2014, and then it's kind of plateaued going on from 2014 on, and then Amazon has once again a consistent slope where they really don't have too much fluctuation going on with their payables. Next, I would like to cover the payment methods practiced by the company. The payment methods that are practiced by the company are for eBay sellers. Their payment methods are PayPal, wire transfer, cash on delivery, cash, and other payment methods that include personal checks, cashier's checks, money orders, and all of their methods are traceable. So most sellers wait for the funds to clear before they post the item to the buyer, and their accounts method are no additional fees that are required from the seller. The preferred payment method on eBay is PayPal, and it accepts all major creditors and debit cards and bank transfers in a one payment solution. And the wire transfers are also known as bank transfers. The buyers deposit the payment directly into the seller's account, and either online or they can do that at most banks. So you have the cash on delivery. The payment of the item is received at the time of the delivery. So people maybe that are in close proximity of one another that can just go ahead and trade cash. eBay does not recommend cash or cash wire transfers as a payment method. The lack of transaction protections and traceability represents a major risk, just in case that maybe say a customer isn't satisfied with the project. If you pay the person cash, it may be a little bit more difficult to trace that money. The payment methods practiced by Amazon is what we're going to be covering next. Paying with a credit or debit card. That is very common when you log into Amazon. You can have your debit or credit card already set up, and that is a very easy way to deal with the payment methods for Amazon. You can also attach your checking account as a payment option, and gift cards, they are redeemable, and any redemption problems, Amazon will handle that. You have Amazon Pay, where you can pay with Amazon on Amazon.com, and you also have pay codes for Amazon, and that's using an Amazon pay code. So they have more tailored ways to have their payment methods set up that are specific to Amazon, that are just there for efficiency and to make things more simple for people. Making a payment through Western Union is also an option, and invoices and other payment methods include a currency converter for people that are maybe international. You can also shop with points, and you can also pay with SNAP and EBT for government assistance. In this next portion, we will be covering accounts receivable monitoring and control to dig a little bit deeper in exactly how this works. So after you sold an item and the buyer has paid, you'll automatically receive your proceeds, but the exact process and timing will depend on the payment method that the buyer used. If the buyer pays with either PayPal or credit or debit card, then they'll send you an email to let you know when the payment is in your account. So with PayPal, when a buyer pays with PayPal, they'll send money directly to the PayPal account. And in most cases, that is immediate. With debit or credit card, you don't have the merchant gateway right away, but it is processed through PayPal as well eventually. And then before that gateway gets opened up, that money is going to be added to your PayPal account. Merchant credit or debit card, if you've set up your own payment gateway, then to your bank account, then it will be credited as soon as the buyer's information is received and processed. And the payment on pickup, if your buyer is paying when they collect the item from you, then you can accept personal checks, money orders, cash, PayPal. We have Cash App now as well. So, whatever is most convenient at the time when you're doing a payment on pickup. Next is the cash positioning and cash management system of the company. Net cash provided by operating activities. The amount of cash outflow from operating activities, excluding discontinued operations. Operating activity cash flow, including transactions, adjustments, and changes in value, are not defined as an investing or financing activity. For eBay, net cash provided by the operating activity has increased from 2016 to 17, but it did decline back in 2017 and 2018. Net cash used provided in investing activities, the amount of cash inflow outflow in the investing activities excludes discontinuing operations, but the investing activity cash flows includes making and collecting loans and acquiring and dispositioning of debt or equity instruments and property, plant, and equipment and other productive assets. So eBay, their net cash is used in providing the investing activities that increase and decrease from year to year. So the cash positioning and the cash managing system of both of these companies is very efficient, and they both seem to work well with managing all of this because of how advanced technology is at this point in time and all of the different payment methods that we have available to us that are pretty much automatic. The cash positioning and the cash management for Amazon is extremely similar to those as eBay. Amazon net cash provided by operating activities did increase from 2016 to 17, and it also increased from 2017 to 18 because their rate is a lot more consistent with their operating activities. And their net cash used in investing activities, Amazon used its investing activities, but it did decline from 2016 to 17, but then it increased from 2017 to 18, but it didn't reach the level that it was at in 2016, but it did steadily increase. And the net cash provided in financing activities, it increased from 2016 to 17, but then it did decline significantly in 2017 to 18. And here is a graphical representation of eBay and Amazon based on their consolidated statement of their cash flows for their net cash provided by the operation and the net cash provided by financing. So it's a bar graph that basically shows you from the positive to the negative side of things how these companies both function and their correlations, as well as what's going on with them for their time wise. So it looks like these graphs are almost mirroring one another based on the interactions that eBay had with their statement of cash flows in 2014. You can see that their net cash provided by their operations was much higher than it was in Amazon's, and then it almost started to get a little bit similar, but then once we got to 2018, the net cash provided by operations for eBay drastically declined, and then the net cash operations for Amazon, it shot up and it increased. So these companies, although they almost do the same thing, their cash flow is very different, and they are just moving in the same direction oppositely. The disbursement and collections is next. Sellers must specify the payment method that they accept in their listings, so it is clear for how buyers are to pay. And in most categories, people do accept the PayPal and the credit cards and everything else as far as methods to retrieve payment. And people are required to pay eBay bills promptly, and a payment to pay that will result in consequences, including loss of selling fees or transactions that they've had cases open, loss of power seller status, and associated fee discounts, selling limits, account suspension, and referral to a collection agency. So once you are referred to the collection agency, whether you have $9 on collection or you have $5,000 on collection, that is still going to affect you dramatically the same. Just the fact that there is an amount there, the numerical value of the amount is not a indication of how much it's going to ding you when it comes to your credit. It's more or less just the fact that you have anything in collections at all that can definitely affect people. So it's very important to pay the eBay bills promptly. And if there are insufficient funds on the account number was entered incorrectly, or the transaction fails for any other reason, it'll be sent to the TRS recovery services for collection, and TRS may telephone you regarding the transaction, and the services will assess a state authorized return. Or they'll check with the bank to see what's going on. But eBay does have a collections, and Amazon does as well. The next portion of what we're going to cover is the liquidity management. Amazon.com Incorporated, their current ratio had deteriorated from 2016 to 17, but then it improved, and then it did exceed 2016's level. Their quick ratio deteriorated from 2016 to 17, but then it did improve, and it exceeded the 2016 level. And Amazon Incorporated's cash ratio deteriorated from 2016 to 17, but then it improved and it exceeded the 2016 level. So they have been, once again, moving at a high rate, going in an upward slope direction. eBay's current ratio deteriorated from 2016 to 17 and from 2017 to 18. Their quick ratio deteriorated from 2016 to 17 and from 2017 to 18. And eBay's incorporated cash ratio deteriorated from 2016 to 17 and from 2017 to 18. So they are more so declining when it comes to their liquidity management, as far as how they are moving cash through their operations. And as for the concluding remarks, eBay's year-on-year earnings growth rate has been increasing over the past 1 to 5 years, and eBay has become wealthy in the last year, making its earning growth rate hard to compare to the 1 to 5 year average, but eBay has become profitable in the last year, making it difficult to compare the U.S. online retail industry average, but eBay has made outstanding use of its shareholder funds and its return on equity, and its assets are better than the online U.S. retail industry average last year based on the return on assets. eBay also has improved its use of capital last year versus 3 years ago, and they pay a higher dividend yield, and their dividend is below the market top 25 of the dividend payers of the U.S. and overall in the U.S. And Amazon.com's level of debt compared to net worth is actually pretty high, but their level of debt compared to net worth has increased over the past 5 years. So debt is well over operating the cash flow, but the interest payments on the debt are well covered by the earnings. So Amazon.com has met all of its short-term commitments and the holdings and the cash and the other short-term assets, and Amazon.com and other short-term assets are covered by the long-term ones as well. So thank you so much for watching, and I hope that you enjoyed this video.